Good morning and good afternoon. My name is Rob Britt, and I'm the Senior Vice President of Multifamily Housing at Zonda Media and Events. And I'm pleased to be included in this multifamily update here today. Arguably, this is one of the most relevant multifamily outlooks that we've presented in the past few years. And I got a sneak peek of the presentation yesterday, and there's a lot of exciting information, numerous critical takeaways. Kimberly is going to address the key questions of when to deliver and in which markets. One of my key takeaways was to get past the headlines of today. And Kimberly is going to take you behind the scenes there. Our presenter brings a unique perspective. Her primary clients are primarily multifamily developers, but owners and operators can also benefit from many of these findings here today. Kimberly has sorted through tons of data points from Zonda's proprietary data, single-family housing, as well as our rental housing outlook, as well as third-party data to give you some national benchmarks and fundamentals to pay attention to, as well as some key markets, which ones are all clear and which others might be on hold right now. We're also going to get a little bit into the build-to-rent space. All in all, there's a ton of great information. Please hang on here for the entire duration. We'll have some Q&A at the end for you to participate. First, a couple of our great sponsor partners I wanted to recognize: Assurant, as well as Propane Education and Research Council. First, a quick word on Assurant. They're a global provider of lifestyle and housing solutions that help leading brands grow revenue, manage risk, and deliver a great experience. Assurant has been dedicated to multifamily housing for over 30 years, supporting over 2.5 million residents and partnering with more than half of the top 50 property management companies as published by the National Multifamily Housing Council. Assurant is with you through the entire resident life cycle, before, during, and after the lease, with a suite of programs that help mitigate risk, increase revenue, decrease bad debt, and increase occupancy. Assurant does this through deposit insurance and recovery solutions. They create customizable solutions that increase your profit, protect your communities, and streamline your operations, freeing you and your team to focus on maximizing occupancy and caring for your communities. I also want to recognize Propane Education and Research Council. They've been a longtime partner of Zonda, media and events, as well as advisory. Propane provides a clean, reliable, and versatile energy source. It's stored on site, which gives builders and homeowners the flexibility to build almost anywhere, and provides power independent of natural gas lines and the electric grid. Building with propane benefits the environment, which is extremely important. The 2023 Propane Construction Research Program helped to eliminate more than 19 million pounds of carbon dioxide equivalent. So we're going to get started here today. And before that, I just wanted to give a shout out for a related in-person event where you can come to see Kimberly speak as one of our featured presenters in person at the MFE conference in Las Vegas at the Fontainebleau, September 30th through the October 2nd. The theme this year is the Multifamily Playbook, how to shape tomorrow's success. So we're coming back to Vegas at the Fontainebleau. We hope you can join us in September. So now on to the presentation. I want to introduce Kimberly. She's the managing principal of our multifamily advisory group, and she brings 33 years of experience in multifamily real estate development and site selection. And she's considered an expert on market fundamentals, resident demographics, and product mix. And she has a strong technical background in economic forecasting and revenue management. So Kimberly, take it away.
Thank you, Rob. I really appreciate you always being my partner in crime on this webinar. So excited to get started and share a lot of information with everyone today. The agenda is going to go as follows. We're going to talk a little bit about the economy, although I think everybody is kind of tired of talking about the economy. We're going to review some of the things that are important for multifamily. talk about the state of the overall housing markets. There's been a lot of talk about housing shortage. I want to define that for us. Jump into multifamily fundamentals, talking about the pipeline, talking about when the pipeline is coming, not just from the researchers' answer, but from what's under construction on the ground today and when the tail of that is. And then talk a little bit about what's going on in the rent growth world and give you my list of markets that I think are prime and ready to begin pre-development activity in. And I want to share, I'm excited to share information on the BTR markets from our Zonda economics research team and from my own research, which is a proprietary outlook that we'd love to share with you if you want to call us about that. And then give you some closing thoughts on where we think the markets are headed and just wrap things up and hopefully have time for some questions. So jumping into the economy. At the beginning of the year, I started a list and I called it words, and I carry it around on my phone and I write down things as I hear them, and whether it be participating in a conference or on a panel or just listening to the news or reading something intriguing in an article in the Wall Street Journal, The Economist, The New Yorker. And so I've got a couple of just phrases that I'm just very interested in sharing. First off, obviously, we're really concerned about the federal funds rate in real estate and inflation, of course, overall in the economy. And so, stalled or sticky is kind of where we sit today. But even more importantly, we're starting to hear the phrase lags and measurements. And you see a lot of people on LinkedIn these days sharing their opinions on how we're not measuring inflation accordingly, and it's either higher or lower than we think. And so we'll continue to watch that, but definitely something that's out there front and center. Obviously, the federal funds rate is front and center for us. I think more importantly, we will start to hear it's an election year. It's an election year more often. And then right now, I think what's really ironic is the whole bad economic news is actually good, question mark. On the opportunity side, and I've got one highlighted that I think is really funny. It was actually my first entry into my list of words, and that was more active. And that was a phrase mentioned by Blackstone, and I think they've proven to be more active so far this year. Other things, numbers don't pencil. Where are we losing income? That comes from management companies that are watching what's going on. So just really watching and thinking about what the sentiment is in our marketplace, and we'll continue to do so. So not to spend a lot of time hanging on every word that Jerome Powell makes, but we do currently, and the Fed watching is at its finest as we go through this year in 2024. I am watching the CME Fed Watch tool is a great data source to understand where the markets are pricing potential decreases in the federal funds rate. If you look at the data currently, we are projecting that there will be probably a 25 basis point decrease in September. Also in November, a higher expectation that there will be some type of rate change. Notably, yesterday in the Wall Street Journal, they said that we are currently in our second longest time period without a rate change. The longest is a 15-month period that occurred between 2006 and 2007. So if we don't see a rate change until November or thereafter, we will have achieved the longest period on record of no rate change. So are we in a soft landing? I really like this survey. About a year and a half ago, we were talking a lot about recession, that terminology has dropped. Interestingly, there is actually a time series that illustrates how many times the word recession is mentioned in the S&P 500 earnings calls, events, investor presentations, and at conferences. And that word has dropped from about 302 references a year ago to about 100 references today. So interestingly, kind of moving out of maybe a fearfulness of a recession into something a little more of a soft landing. Something that people ask me all the time is, what are you watching? And I watch before I leave the house every morning, I check the 10-year treasury and I check it throughout the day. It is definitely taking us on a roller coaster and certainly impacts what's going on in multifamily. We are at a 2-year or near a 2-year high, in a 2-decade high, moving up and down around the 4.5% range. Almost touched 5 a while back, but came back down. If you look at the ULI forecasters, I think everybody's thinking that goes back to 4% here towards the end of the year, but I think we'll probably bump around that 4.5% for some time. So where are we headed on the U.S. job growth? And again, this is what's really important to multifamily. We track jobs. We like jobs because jobs are a pretty immediate measurement with a couple of months lag. So it's a great way to gauge what's going on in the economy. I want to point out a couple of things here. I was actually sharing this presentation with some of the younger team members this week and said, look at, since you've been in the workforce from 2014 to 2019, we were at a very stable period. Of course, money was very cheap then. And you can see we bumped around in that a little over 1.5% job growth range. Obviously, the pandemic changed things and we had a slingshot effect back up. We've gained back all the jobs, at least from a percentage basis, that we lost during the pandemic. And the question is where are we headed? Currently, we're at about a rate of 1.8%. I trended out the latest jobs report at that 175,000. And if we keep that rate through the end of the year, we would fall down to about 1.5% growth, which isn't bad. It kind of falls back into what I call that macro stable period. So not worrisome at all. If you look at the expectations for the future, at least the next 2 years, the consensus forecasts are expecting a drop under 1% in 2025 and half of that in 2026. Currently running at about 1.4% for 2024. So again, trending out that 1.5, that 175,000 jobs. So I point this out to say that my forecasts are contemplating this average of the consensus forecasts. And so assuming that there will be some kind of slowdown in the economy in 25 and 26. I love this chart and I watch it on a regular basis. I think it's very important to understand certainly where consumers are, but our residents in the multifamily space. And so as you can see, the dark blue line is how I feel about my situation today. And the baby blue line is how I feel about my situation in the future. And for the most part, we feel better about what's going on today than we do in the future, except for during COVID and other times when the economy was down. But we also see that there is this big gap between where I think I am today and what I'm worried about in the future. And it has started to move down. It's actually at its lowest level since July of 2022. What really stands out to me in this latest data is that employees are feeling much less comfortable about their job situation. And I think that's important because while we haven't seen a lot of job loss, we are seeing that people are feeling less fortunate about where things are going in the future. So they may stay where they're at. They may stay put longer. And I'm going to share renewal data later in this presentation, and you see that we've already had people staying put, so that could actually extend out longer, which could be good for our rent rolls. So I want to switch and talk about the state of the housing markets. And we've been talking a lot about, you hear this a lot with a really broad brush, oh, we have localized supply problems, but we have an overall housing shortage, so we really need, that's okay, we can just kind of skip that idea. But I wanted to talk a little bit about what we really see on the housing shortage data. So I spent quite a bit of time researching all of the different sources who have calculated what they think that the nation's housing shortage is. And as you can see, you have a cluster of providers or of researchers who fall in that $1.5 to $2 million, 2 million unit housing shortage. And then you have another group that kind of congregates around 3 to 4 million units of shortage. And then you have all the way up, you have some outliers in the 5.5 to 7 million range. So overall, we have a really wide range on where we think that housing shortage falls. But overall, you can see that also on the low-income housing side, there's a number that suggests that we're 7.3 million units short of affordable housing, which, by the way, I'm going to train some nonprofits this afternoon on market feasibility, so helping those people get product to market sooner. But overall, we think that there's some reasonableness. Zonda's number falls in that 1.8 million range currently. And so overall, we think that we'll fall somewhere between that 1.5 to 2 million units. So where is the underproduction? This is actually a map that's produced by Up for Growth, and it's as of 2019. So no surprises here. You see that the large growth states in California have large housing underproduction. But I think more importantly, or interestingly for sure, is the Midwest. It is an area that has been overlooked certainly by multifamily, many of the major developers. And it is experiencing very strong rent growth. And I'm going to share some of that more in the future. But don't count out the Midwest would be a takeaway. So what this is showing is Zonda actually produces market summaries for each of the major housing markets. And I have summarized our key multifamily markets into 3 buckets. Buckets that are what I would call balanced housing markets, and that is really a measurement based on permitting. And so we've got places like Denver, Oklahoma City, Salt Lake City, Nashville, that are in what we would call balanced market areas. Then there are those that are underbuilt by between 1% and 3%. And those are places, as far away as Portland, Phoenix, which has major growth and continues to grow in a need for housing. Then you have Florida, Jacksonville. There pops up a Midwestern market, Columbus, Ohio, and then of course Orlando as well, which is a great migration market. And then the markets that are underbuilt by greater than 3%. And some of those again are very familiar. And actually those in orange are markets that are currently experiencing localized pipeline issues when it relates to multifamily, but overall, the overall housing market still continues to be underbuilt for sale and for rent communities. So how does that impact pricing? So I took those same markets and calculated their existing home price based on Zonda's market summaries. And you can see that for those markets that are in that balanced or slightly oversupplied group, an existing home trades at about $450,000. When you compare that to markets that are undersupplied, that price increases to $585,000. And then those that are even tighter in terms of housing shortage would be $615,000 for an existing home. So basically that housing shortage is, simply impacting housing prices between 30 and 35% just on a as right now basis. So taking some of the markets that are on the outliers, so these are just the outliers, not the ones that fall kind of in the middle. I think it also paints the same picture that you would expect. Undersupplied housing markets typically have high existing home prices, and those are the ones that we would expect to see up there in the California area, Miami as well. Washington, D.C. is kind of on the edge there. We are building housing there. We are building multifamily there. It's been a high price market, but it keeps that price down somewhat and kind of is really on the edge there. Some of the markets are oversupplied, and that has helped keep their existing home prices low. And you can see that Houston, for instance, continues, and I'm not saying super oversupplied, but a little oversupplied, maybe 1%. And you can see that actually helps the existing home price and keeps that price down. Of course, the markets that we are the most interested in are the ones that are undersupplied, and Dallas, Atlanta, some of those places that are continuing to grow are undersupplied, but have, because of the ongoing development on the multi side and on the single family side, has kept those housing prices lower. So what's the shortfall of apartments? And looking around, looking at all the research, I, of course, always turn to the National Multi-Housing Council, who does an excellent job of estimating these numbers. The last time that they estimated these numbers was in 2021. They have great research and great methodology, so please take a look at that report if you are a member. But overall, to summarize their base case scenario, basically what they're saying is that we need about 310,000 units a year to keep our market balanced and to address demographic growth. And this is a base case growth scenario, not a open up immigration and changing the way people are buying homes, et cetera. This is just base case, keeping things the way they were. So that falls and is very consistent with what Moody's estimate is of the shortfall of multifamily, which is 400,000 units. So, and by the way, that is just a number that we've always kind of talked about even back in, the early 2000s, which was that we needed to build about 400,000 multifamily units in order to keep the market balanced. So all that kind of passes the test there. So switching over into the multifamily fundamentals, again, as I mentioned, I'm going to talk about what our forecasts are, and then I'm going to dig a little bit into what we're seeing currently in the markets, and then I'm going to give you a preview, or I'm going to give you my suggestions on where the markets are ready for pre-development activity to begin to occur again. So every conversation in multifamily starts with pipeline. So we definitely want to talk about what's under construction and what we're seeing. So a couple of things on this chart, and I did take this back to the 2000s because I wanted to show how many quarters we were not producing enough multifamily during the Great Financial Crisis. Of course, we did jump back up in terms of producing more units, but really didn't get to 500 units under construction until the first quarter of 2015. And so there's an important point here too. Pre-pandemic, we typically will deliver about 40%, or I'm sorry, almost 50% of the units that are under construction in any given year. So if we have 500,000 under construction, we would be delivering 250, which by the way is below that 300,000 unit mark that we'd like to see. So as you can see here, during the pandemic, we actually dropped our deliveries. Our deliveries were cut to about 30% of what was under construction. So we stopped bringing units to market during that time period. And so we've seen this slingshot effect. I actually took the projects under construction and simulated what would have happened if we had kept at that pace of about 50% of the units delivering each year during the pandemic. And we would not have had that slingshot in occupancy up to 97% because our deliveries would have been more consistent throughout. So just an important point that pandemic really caused a stoppage as well as that bounce back, and so would have kept the markets a lot more consistent throughout. We are dropping, probably most importantly on this chart, is that we are dropping very consistently the last couple of quarters in projects under construction, and we'll continue to see that. On point two, on the gold in the chart illustrates when we went to the next 100,000. So you can see to get from 500,000 under construction to 600,000 under construction, it took us from 2015 to 2018. And you can see that over time, we started pushing that up faster, and we went from 900,000 under construction to 1 million in just 2 quarters. And again, that is that bounce back from the COVID time period. So if you don't remember anything else that I talk about today, please remember this slide. This is the slide, and this is my estimation of the big question that people ask me every day, and that is, what quarter should I be delivering units into the market? And so what this is showing us is that we're currently in our first wave of deliveries. Over 400,000 units are being delivered currently in this as of the first quarter. So that is coming through the system currently. We expect to see a second large wave of deliveries hitting the market in the second quarter of 2025, so next year. So this year currently, and then the middle of next year are when the 2 big waves of construction or new construction will be hitting the market. But you see we fall precipitously beginning in the first quarter, and by the fourth quarter of 2026, we are at what I would consider the gap. And that is the gap below 300,000. So if you were asking me today, when is the best time to deliver units into the market, that would be after the fourth quarter of 2026. So how will that impact occupancy? So reminding you that I'm taking into account the slower economic performance that the consensus forecasts are projecting for 2025 and 2026, and obviously the wave of new supply that I just shared. We do expect a drop in occupancy from almost 94% to just below 93. That is still above the inflection point that we saw during the great financial crisis. But and again, assuming that our job market continues at the rate it is currently, we should be able to handle that and keep occupancy slightly below 93 or just at 93. As that pipeline moves its way through the market in 2026, we do expect a little bump up. This would be a better bump up if the job numbers were projected to be better, but I am assuming that we would see slowdown in jobs in 2025 and 2026. So what does that mean for rent growth? So for the next 2 years, we are projecting negative rent growth or negative rent adjustments to the tune of about 2% per year. And you can see this year, we're thinking it might be a little positive or somewhat flat. Again, these numbers change if we plug back in 1.5% job growth as opposed to 0.8 or 0.4% job growth. That would be a little negative in 25 and then a little positive in 26. So we're watching this. We're certainly relying on what the consensus forecasts are currently, but we'll continue to watch this and keep you apprised of where we think the market is headed. So how are some of the markets doing? The top absorbing markets in 2024 compared to their performance in 2023 is pretty remarkable. Of course, where units are delivered, units are absorbed. And so we see that in all of these top 15 markets, absorption is eclipsing last year's absorption by 2x. Dallas is absorbing just in the first quarter about 6,000 units compared to about 2,300 last year. And you can kind of take that all the way down. But all of these markets, with the exception of DC, which is a little bit closer to last year, and Houston, are really, really outperforming what we had seen in the last year. And you see that and you read about that. That comes up a lot as the pundits on LinkedIn talk about the positive side of what's going on in the market. Definitely seeing strong absorption. Where is occupancy in most of these markets? And by the way, these are the key markets that we underwrite projects in and where our clients are. If you have questions about a certain market, I'm always happy to share with you our insights on those. But the chart gets way too big if we include 150 markets. So these are the markets that our clients are the most interested in. Overall, we have seen occupancy fall about 100 basis points, about 1%. A few of the markets are a little over that. Fort Myers and Sarasota being the largest drops with more supply than they've ever had historically. So really absorbing that and seeing those occupancies fall. On the other side, San Francisco and San Jose are coming back. Certainly San Francisco is making its way back up. And we would expect San Jose to follow pretty closely pretty soon. So overall, this is where we see the occupancies. But rents, where is the bright spot? And you've read this, you've seen this, the Midwest. The Midwest continues to see strong rent growth over the last year compared to some of the other markets. Of course, the Northeast, which has tight housing markets as well, also seeing strong rent numbers. In the South and in the West, where we are competing with a lot of new supply, we are seeing some negative rent adjustments. People always ask us about floor plans. How do floor plans compare to one another? So I wanted to take a moment to share just the history of how floor plans move and then where we've seen them lately. So overall, as you can see, rent growth is pretty consistent on studios, 1s, 2s, and 3-bedroom floor plans during that macro stable period that I pointed out earlier, that 2014 to 2019 timeframe. We did see the 1 and 2 bedrooms outperform, but that's ever so slightly. So yeah, outperform is a really strong word there. During COVID, as we all know, we saw a lot of people moving into larger units, and there was some more pricing power illustrated in the 2s and the 3 bedrooms. Last year, we gave a lot of that back, and we are seeing a little bit of outperformance with the 3 bedrooms currently, but we would expect that to go back to more pari passu as the markets start to balance back out. What about by age type? This is very fascinating. As you can see, overall, the older product typically garners a higher rent growth than the newer product does. Of course, the newer product being on the high end of the pricing range. In some markets, in order to live in 2000s plus product, you have to make six figures. And so their rent growth on those numbers is smaller than you would see on the older product. Overall, the gaps between a 1970s product and a 2000s product means that a renter would have to earn between 25,000 and 35,000 more per year in order to move from a 1970s product to a 2000s product. So something to be mindful of. A couple things here. During the macro period, that stable period, you definitely saw the older product again, because some of that could be just from renovations, improvements that were occurring there. During COVID, you did see some leveling out of performance in that you saw the 2000s product getting about almost 7% or close to 7, and then the others getting a little over 7% rent growth. And then last year, pretty flat on the newest product and actually negative on the 1990s product. That could potentially be people moving up into newer product there with that pricing gap being $100 or somewhere in that range, moving into a newer product type. The 90s product is great. It's not very obsolete, but you still see a lot of galley kitchens and less storage, things that they really corrected in that 2000s plus product. And so, just from an obsolescence standpoint, maybe moving up to an open kitchen with an island versus the galley kitchen. So things like that are more favorable in some of the design.
Hey, Kimberly, can I
Yes,
interrupt you for a second? If you
yes.
can you hit hide on the Zoom app at the bottom of your screen there? There you
Sorry
go.
about that.
It's
Thank
just
you.
blocking some key info.
Thank you. Thank you. Well, thanks for that, Rob. And I am coming to a very, very difficult slide. So I'm glad you can see everything. Want to talk about the impacts on rent rolls. So I want to talk about the different ways that we report rent growth. If you look at the green bar, that is asking rent, and that's the researcher's rent, right? I call a comp today and I call a comp in 30 days, and the change in those prices is my asking rent change. The blue bar is renewals, and that is what we pass along to our renters that are renewing their lease that are currently in our communities. And then finally, that trade out is when I don't successfully renew someone and they move out, and the new resident that I move in, that is what I'm trading out from my renewal to my new move in. And so overall, historically, we see about 150 to 200 basis point difference between asking rent or researcher rent and trade out. On the renewal side, you typically see those up 100 to 150 basis points. I have the great financial crisis on here because I wanted to show even during that time period when asking rents were negative and lease trade outs were negative, we were still passing on somewhat of a renewal increase to our existing residents. And so you see during the COVID time period, again, everything became very similar. We were renewing, asking, and trading out at a similar rate. If you look at our current, we are still having a lot of renewal, and I'm going to show you that chart in here in a second. But you see that asking rents are down or a little negative, and current renewals are at 4%. And of course, that is impacting our rent roll and our lease trade outs to 1.7%. So I want to talk about that and show you some calculations that I've done to kind of shed some light onto the complete picture of what's going on rents. But I also pointed out here, because some of us on the call are interested in BTR and SFR. The latest SFR REIT reports are actually sharing that they're still passing on 6% on their renewals. So that's compared to our 4% on the higher density multifamily, and 2.2% to the positive on their lease trade out. So overall, they are seeing a little bit of more positive change than we're currently seeing in the higher density. So how are we doing in renewals? And this is one of my favorite things that I've watched, certainly during COVID. But overall, I wanted to share that during that stable time period, we typically will renew about 52% of our residents during the Great Financial Crisis. And that was a time when there was job loss, several years of job loss. We actually saw renewals decrease below 50% to 47%. During COVID, we actually saw renewals at their highest level ever as people were staying put and not moving. And again, kind of going back to my slide that I talked about earlier with resident how people are feeling about the economy and their expectations. I also think that plays into that. And then currently we're still at that 54%, so above our average, and have nowhere near where we saw the moving out that occurred during the great financial crisis. Again, kind of pointing out the difference. Single family REITs reporting 76% renewal, so a lot stickier in the single family markets. So how does this all impact our rent roll? And so I wanted to point this out because I think this is a really interesting analysis. So what I've done here is I've taken all of the top markets that are reporting what I call researcher negative effective rent changes. Okay, so you see Fort Myers and Austin at the top and Las Vegas at the bottom, and Dallas is down there as well. So I've taken those effective rents, the researcher rent called, and this is the year over year change. Then I've looked at new lease trade out data, which is again, I was not successful in renewing my existing resident. That resident moved out, and the new resident that moved in is paying 5% less in Fort Myers than my previous resident. I'm also getting renewals, and I wanted to point out, certainly at the bottom of this chart, you're seeing very strong renewals in places like Dallas, Tampa, Nashville. So our renewals on the strong side. So if you take that blended rent, what is the blended rent from the renewal activity and the trade out activity? And what you're seeing is that in Austin, where the researcher says that rents are gone down 6.7% on asking, the actual rent roll has gone down about 3.2%. So just be mindful of the impact of renewals. And as an operator, and Rob and I talked about this yesterday, as an operator, this is where renewals are so extremely important and will really help you over the next 2 years as we go through these waves of pipeline, is to really focus on that renewal activity, keeping the renewal percentage up, but also the percent of people renewing as high as we can. Finally, just want to talk about concessions really quickly. This is the top concessionary markets as of the first quarter. No surprises here. Obviously, in the markets where there's more pipeline and higher priced markets, you're going to see higher concessions. A lot of this is more urban, so we see higher concessions on towers because the pricing is so high. One of the things that Fort Myers catches my eye, because it looks to me like the newest product is the shiny penny, and the older product is maybe losing out demand to the newer product. So in this case, you don't see the highest concession on the newest product. You're seeing it in the two products before that, the 2 decades before that. So that's an interesting thing. And then Sarasota is a little bit of an outlier as well, where you see the oldest product in Sarasota is having to really concess their units in order to keep their residents. And again, it looks to me like people may be moving up in some of those Florida markets to the newer product there. So finally, and the drum roll is, what is the best time to deliver and where? And so what I have done is, again, taken that gap that we talked about earlier, which is the fourth quarter of 2026, and that's that line, that milestone line where the gap is. And I've taken, if I assume that you start pre-development tomorrow and all of these product types, where would my completion of my units be? And I'm assuming a 9-month pre-development phase, except for towers, which I assume is a 12-month pre-development phase plus construction. So as you can see here, if you're delivering garden product and you're starting tomorrow on pre-development and everything goes the way that you want it to, then you would be delivering after that milestone gap occurs. So all product types fall beyond that gap based on their construction, but for townhome and BTR, and that's a traditional SFD. And the reason for that is it just takes less time to get those to market. And I'm assuming, so we're right kind of bumping up against the gap in that product type. The cottage style goes over that because it does take longer to get cottage style product to market. The municipalities are still very confused with it. And so it takes a while to get that product over the finish line. So overall, all of the product types fall outside of the gap if you started pre-development activity tomorrow. So what markets do you want to be in? So methodology-wise, I looked at what was under construction, and I've had a lot of equity say to me lately, don't give me the researcher answer, give me what's under construction and when it all ends. And so in taking that idea and that notion and kind of applying it to the different markets that we are active in, the ones that fall in a all clear to begin pre-development activities currently are the box on the left-hand side, with San Diego and San Antonio kind of on the edge there. but enough to put them in the all clear as time goes by. On the proceed with caution, those look really good also, but take your time, not want to rush to get to product to market, but definitely those are ones that are all in the getting close to the all clear. And then the hold for now, most notably, I also add number 11 and number 12, which are Charlotte and Raleigh. They have a pipeline that they're working through, but they're going to be on this list probably in a quarter or 2 quarters. So I would slow play anything I'm working on there, but certainly that starts to make the list here in the near term. But there are still some markets that I would avoid without a clear jobs or growth story. Obviously, first and foremost is, and this is the units under construction as a percent of existing stock. The poster child for basically doubling the inventory is going to be that West Valley in Phoenix. It's going to increase its supply under construction is 55% of the existing stock. So really building a submarket that wasn't there 10 years ago. The ones that are hitting that 30% mark, of course, Dallas is on my list. I would watch Allen and McKinney for sure. I would make sure that my location was not surrounded by 7,000 or 8,000 new units, but I'd find somewhere that made sense if I was going to go in that direction. And then those that are in that 20% range, there's some markets in Nashville, the central Nashville, North Nashville that I'd watch out for. San Marcos is interesting in Texas because it's lumped into the into the Austin MSA. But it is kind of its own standalone. So when you think about Austin, you really have to take out about 6,000 units under construction that are in that San Marcos area. And then finally, those that are 15 and 10, probably not as worried about those. In that that's usually a growing area like a Denton that was a lot of farmland that where a lot of the population is headed. So wouldn't be as concerned about those. But all of these, of course, need a good job story or a growth story. So switching to build for rent, and I'm gonna speed up so that we can get to some questions. I'm very proud of this slide, and this was produced by our Zonda economics team, and so I want to give it the justice that it deserves. But when you think about BTR, you really have to think about this demographic slide. Because we're in a really precarious situation, again, talking about our housing shortage, in that we have, the millennials, and we've been talking about the millennials for years now and how they work themselves through this system. Currently, the median age of a first-time home buyer is 36 years old. And as you can see, we have a whole wave of millennials that are kind of heading into that age bracket, but there isn't enough product for them to buy. And furthermore, it's more expensive than it's ever been. And so this BTR product really meets a need for those millennials that are coming into this time period, but just either can't afford to buy a home. And I'll show you the results of our Zonda millennial survey here on the next slide. Or just don't want to. Another part of this slide that is really interesting to me is that oldest Gen Xers and the youngest baby boomers. There was actually a really good article in the Wall Street Journal today about the oldest baby boomers and how they're impacting the shortage of housing in the United States currently. But this younger set of baby boomers and older Gen Xers, they may be a prime candidate for BTR as well, or maybe even active adult BTR, or certainly active adult, the product type. So overall, a very large number of this group, if there was product out there for them. And then, of course, if you're in the student housing business, you'd like this chart as well, because you're seeing at least 7 more years of over 4 million people that are in that prime college age. So looking at this slide really kind of just puts the product type into its own category and makes you understand what the need is and why the popularity. Again, renting is more affordable than owning in most of the BTR markets. Overall, nationally, owning a home is right now 82% more expensive than renting a 2-bedroom apartment. And this is per our Zonda economics team. And they produce this information on a quarterly basis in our rental housing outlook. From the Zonda's annual millennial survey, you see here again, millennials, what's your main reason for renting? Because there's still 17 million of them that are renting. And the answer is, I can't afford to buy a house. I can't afford the down payment, or I can't find anything. I can't afford to buy anything where I want to live. And those just all affordable. But that second tranche is also really interesting because they aren't at that life stage yet. And I think those are the people that are, in those lines that are that are below 36, where they're saying, I don't know where I'm going to settle down yet, or I like renting and I like the flexibility that goes with that, or you know what, I'm not going to buy anything until I get married and settle down. So there's that lifestyle choice as well. So, but overall, affordability is a main concern, and I do think the BTR segment is meeting the needs there. Where are the largest BTR markets? Well, everybody knows about Phoenix. That's no secret. But second to that would be Atlanta, Dallas, Fort Worth, and Charlotte. What's missing from here, and we've kind of talked a lot about that, or I've tried to make that point, is there are not a lot of Midwestern markets in this prime market area. So definitely areas of the country to look at. Which, by the way, the newest product in the Midwest is the same price as the newest product in the South. And I think that always used to be one of the reasons why we always avoided the Midwest, is because we thought the rents were a lot lower there. But they're not. They're actually on par with what we see for 2000s product in the South. Overall, so on the smaller project side, or the smaller number of unit side, places like Orlando, Sarasota, still on below 2,000 units. And who are the top developers who have built this first wave of new development? You can see here Next Metro, D.R. Horton, Christopher Todd. So a lot of those name brands that you're familiar with that have added a lot of units to this BTR markets. So where are we going with deliveries? As you can see, BTR is at least 10% of rental deliveries, and in that wave in many of the markets that we talked about already today. The Twin Cities actually doesn't build a lot, and so there is a little bit more BTR coming into the market there, but that is almost a function of just not building a lot there. And then you also see Columbus in the Midwest, as well as Denver, which is a market that already is on my start pre-development activity again. So overall, we are seeing that become more of the delivery in 2024 and 2025. What's the pricing? Well, the pricing, again, kind of talking about millennials and affordability, we typically see unit offerings between $2,000 and $2,500. That's the majority of the inventory here. So that means if you qualify on 33% of your income, you need to make between $72,000 and $90,000 a year to live in a newly constructed build for rent community. So that's pretty affordable in terms of when you compare that to the home ownership. This is actually a summary of amenities, and I bring this up because I analyzed I looked at all of the lease-ups in the South and Southeast for another presentation that I did, and I wanted to share that the most successful lease-ups, the top 20, some of the amenities that they had in the BTR space, and compare that to a typical garden-style community. Overall, you do see on-site management at between 70 and 75% in the BTR space. Of course, the typical garden style's got full staff 100% of the time. Pool seems to be something that the best lease ups are including 80% of them, as opposed to, of course, multifamily, which is only 100%, or everybody has a pool in multifamily. Some of the areas that are different is the gated communities. You see most of the typical garden is going to have a gate compared to the BTR space, which is maybe 30 or 15. So a single person, you might want to think about, they would be weighing the security aspects compared to a higher density multifamily. And then most importantly, and especially as it relates to millennials who are a lot more interested in the environment and environmentally friendly green activities, one of the areas that I do see is that in the BTR communities currently, we are behind as it relates to EV charging stations and electric vehicle. Just that notion that more of our residents will need those charging stations. So something to be mindful of. When we do see the EV charging, it is primarily in townhomes where they do have direct access garages. So how do BTR absorb compared to your typical multifamily? This is a really interesting slide. So at the bottom, so on the right-hand side, you have the types of BTR listed by cottage, single family detached, and single family attached. That's actually a hybrid product type where they might have some of both on a property. Your attached, townhomes, and single family detached. And in parentheses is the average project size. So if you look on the left-hand side, you see all BTR moves in at a pace of about 9 units per month. And that is compared to garden product, which is moves in at about 20 units per month. And this is, by the way, the actual absorption rates of 2023 lease ups that I analyzed. Overall, wrap and podium, we're moving in at about 16 units per month. And then the tower product, there wasn't much of it in lease up last year, moved in at a pace of about 14. So when you drill down and you peel away at the types of BTR, you see that cottage moves in the quickest, and that the single family detached moves in the slowest. And that has somewhat to do with how they deliver homes and move people in. But overall, so they may be in construction longer in the overall project because they're delivering a few homes a month. And then townhome also a little bit higher than 8, but still kind of in that 8 range. So overall, we also see similar lease up concessions in the BTR product type that we do in multifamily. So that is something where they are somewhat the same, and that they are absorbing less, but also offering the same concessions. So quick takeaways on this. Obviously, the product is appealing to the older millennials. I like that. Focusing on my list, I would take a look at San Antonio, Dallas, Houston, and of course the Midwest. I would watch pipeline, but I'm not too worried about BTR compared to higher density because it's usually farther out. So they don't have as much competition out there. Underwriting concessions and slower lease ups, or figuring out how to lease them up quicker. Underwriting higher renewal rates than we would see in multifamily. And again, planning some of the community level amenities. I think more importantly, what I've heard lately a lot as I've been talking with people and participating in different of the sector's conferences, we hear that the early market entrants are trying to develop management capabilities and understand, operating when you leave Phoenix and you start moving towards the southeast, you are running into things like insurance and taxes that are much higher. And so trying to figure out how to underwrite those in those southeast markets are things that I think the industry is moving through it currently. So finally, just want to say that we're going to sit around and hang on every word that Jerome Powell says for the rest of this year. And we'll hopefully, I think that his term is up in 2026. But overall, I think we're still going to have a lot of uncertainty going throughout 2024 as it relates to the economy. But rest assured, we know where the gap is. Consumers are apprehensive and will continue to be. And I think that works in our favor if we can work our renewals. The opinions on housing shortage are plentiful. We think it's between probably 1.5, 1.8, but reasonably between 1.5 and 3. I think that we feel pretty comfortable with that 300 to 400,000 multifamily units being delivered a year. Single family is unaffordable and getting more expensive. Already shared with you that the gap is probably the most important thing that you need to be thinking about right now. And no surprises, we will start to see some rent declines, or are seeing rent declines and concessions as we're leasing up our pipeline and trying to close the back door. So Rob, do we have any questions?
Great job, Kimberly. We do have a couple of questions here. Stephanie Baring has one for you about the DFW market, and she's curious as to why DFW is considered underbuilt in one of your slides by more than 3%. And I guess there was some headlines out this week in Dallas Morning News reporting the severe oversupply. Maybe you can kind of put that into context,
Yes.
given your time frames.
Yes, that is based on Zonda's proprietary data. And what we look at is, again, the pipeline, the permit activity compared to the overall growth in households as well as jobs. And so that is an overall static measurement, and we stand by that. I'd love to get them in contact with Brian Glasshagel, who can also talk very, very eloquently about the DFW market on every project in the pipeline.
So you're still bullish on DFW?
I am absolutely that. And interestingly, just so you know, on the multi side, Dallas did slow down during the pandemic. And I've been saying that, most of my career, Dallas is in an oversupply, somewhat, localized supply issue in multifamily. And they really did stop during the pandemic and have started to have to play catch up for sure.
And a quick follow-up from Stephanie. When you speak of bringing something to market, do you have a definition of that? Is that lease up? And she's coming at it from a context of an architectural firm. is how they're looking to manage their projects?
Yeah, so my assumption is that there would be a 9 month pre-development, and then I would tack on, like for instance, for garden style, it would be 26 months of construction. So that would be completion. So completing that project would be, after the gap. So you'd be probably pre-leasing 6 months before that.
Got it. And I have a question from Tim Paul, and he's asking about the data that you're looking at in multifamily asset classes. Do you compile data on other classes, or is it all combined? For example, condominium, senior living, student housing. How do you consider all that?
I look at those separately, and that's why, even in my BTR data, you have to make some judgment calls on even the different types of BTR. So literally looking at every site plan to determine what different BTR segment a project might be falling into. But for sure, I would look at all those segments differently. So this would just be for class A, B, and C multifamily in the 5+ segment. That would not include seniors, active adult. That's Nick actually has some data that they're beginning to compile on active adult. There hasn't been good data thus far in that market. So that's an area that we're working with industry experts to get clarified.
Excellent. Okay. So yeah, and there have been many questions about getting a copy of the presentation. There will be a copy available. There's going to be a survey that's sent to everyone, and you can request specific information, or you can even email Kimberly directly on any of the questions I didn't get to in the chat. Um, as Kimberly's presentation was geared on a kind of a broader scale, although she did cover some of these key markets. I think what you want to look at and where Zonda Advisory can help you is in a customized strategy for your market, whether it be multifamily, single family, build to rent. Uh, we have a building product manufacturer specialist, Todd Tomalak, who can assist and give you all different perspectives on that. So I'd encourage you all to utilize Zonda Advisory as a resource going forward. Also wanted to point out that or Kimberly used data on that build to rent segment from our new rental housing outlook product. So if you want to access similar data, we have a subscription service for that, and it's in-depth proprietary data and analysis on this highly important segment of the rental market. So again, we're going to have this recording posted within 24 hours, and it's going to be on all of our social media channels, but you can go direct to our blog where you can get to the recording of this at zondahome.com/blog. And want to thank you all for coming today and engaging with us. And we'll look forward to seeing you next time, and hopefully seeing you at the MFE conference in Las Vegas in person.